The structural container of your account type dictates your survival long before you execute a specific market strategy. A common error for beginners is funding a standard account with micro-level capital. When you pair a massive trade size with a tiny bankroll, a routine market fluctuation instantly liquidates your balance. Selecting your account tier is a mathematical alignment between your available capital, your risk per pip, and your transaction costs. This matrix breaks down the 4 primary account tiers: Standard, Mini, Micro, and Cent. The defining difference is contract sizing, called a lot. These lot sizes dictate the specific monetary risk you take on for every pip the currency moves. Running these numbers is the only objective way to figure out exactly which tier matches your current bankroll. Look at this capital routing flowchart. If you are starting with under $500, you land in the Cent and Micro tiers. Funding an account with this micro capital means trading strictly in 100 to 1,000 unit lot sizes. That cuts your financial risk down to mere pennies per pip movement. The trade-off is that your profits are mathematically negligible, and brokers often charge higher relative spreads to compensate for your tiny volume. These lower tiers function as paid practice arenas. They allow you to test your strategies with real money without the fear of ruin, but they are not designed for generating a meaningful income. Moving down the flowchart, committing between $500 and $2,000 routes you to the Mini tier. Mini accounts step your volume up to 10,000 unit lot sizes. On major currency pairs, this scales your risk and reward to roughly $1 per pip. While balanced, the Mini tier lacks the high-frequency scalability and the absolute tightest raw spreads demanded by algorithmic or full-time day traders. The Mini account serves as the optimal psychological bridge, transitioning you from a demo environment into managing real-world risk. The final branch on our chart requires deploying $5,000 or more in capital, entering the professional tier. Here, you are commanding 100,000 unit standard lots and utilizing direct market access models. You unlock institutional-grade conditions, advanced charting tools, and drastically lower transaction costs. But the risk exposure is extreme. Standard movements at this level are valued at roughly $10 per pip. This graphic shows the reality of that math. A completely routine 50-pip swing against your position results in a fast $500 loss. While this tier maximizes profit potential, it will instantly liquidate an underfunded account. Matching your capital to your lot size is a requirement that cannot be ignored. There is a modern loophole traders use to access premium features without massive capital: fractional trading. You open a high-tier standard account, but you manually restrict your trade sizes down to fractional lots, like 0.01. This grants you the tight spreads of a standard account while maintaining the financial safety of micro-level risk. The danger lies in your excess margin. Because the account allows for larger sizes, a single moment of greed or tilt means you can type in a bigger lot and catastrophically over-leverage. The fractional workaround is mathematically sound, but it removes the system's safety rails. It relies entirely on your ironclad emotional discipline. These tiers lead to a specific mathematical requirement for account selection. You should not trade a standard account with microcapital. This quadrant chart maps platform features and spreads against your required capital. If your goal is fear-free software learning, explicitly choose the Micro or Cent accounts in this zone. Accept slightly wider spreads as the necessary cost of your financial safety. If you have a verified strategy and over $5,000 in capital, you must transition to the top tier to optimize your income. Ignoring this map is the primary reason new traders blow up their accounts before their strategy ever has a chance to succeed. For those who have successfully scaled their capital into the professional quadrant, you need a high-tier environment built for institutional scale. Structures like the FXNX NX1 account are the logical destination for those ready to optimize their trading. The raw 0.0 pip spreads provided by these premium accounts make standard lot sizing mathematically viable and highly efficient. Objectively evaluate your starting bankroll, respect the mathematics of lot sizing, and choose the exact account tier that matches your reality.